Hello, I'm going to talk about the accounting equation, and hopefully by the end of this video we're going to have a better understanding of what this concept is. So before we get into the definition of this concept, let's first of all try and understand the contents of this equation. So we have here the accounting equation: assets equals liabilities plus equity or capital. This is the accounting equation. So assets, examples of asset will include things like cash or cash held in your bank account, accounts receivable or otherwise known as debtors. We have stocks or inventory. You'll have properties or equipments, land and buildings. Anything of monetary value to the business is regarded as an asset. Okay? And then, so the asset will equal liabilities. Liabilities is everything that is owed to third parties by the business or the company. For example, a loan payable. This is a liability. It's money you need to pay back to third parties. Accounts payable or creditors. For example, you bought goods from a shop on credit, you did not pay cash for it, so you need to pay creditors. Now, wages payable, you have employees working for you, you haven't paid them their wages, that amounts to a liability and it becomes a wages payable. Or rent payable, you haven't paid your rent, so you owe your landlord some money for rent, that's a liability. Tax payable, you've made a profit in your business, you need to pay corporation tax, for example, but you haven't paid this tax yet to the government, so this becomes a liability. So basically, anything owed to a third party by the business is a liability. And then come here to equity or capital. So equity or capital is essentially share capital of the company, or you could also retained earnings forms part of equity. Retained earnings are basically company's profit. Those are retained earnings. So assets equals liabilities plus equity. That is the equation. Now let's move down here. Just a second. Let's tie this up. There. Now, the accounting equation is the foundation of the double entry accounting concept. Basically, assets equals liabilities plus equity. So everything that the business owns will equal everything that the business owes. Again, everything that the business owns will equal everything that the business owes, and this is the basis of the accounting equation. Assets equals liability plus capital. Everything that the business owns, other assets, equal everything that the business owes either to a third party or the owner of the business, because the owner of the business and the company are two different entities. A company stands on its own as a separate entity to the owner of the company. So if the owner of the company puts some money into the business or into the company, then the company will owe the owner that much money. Okay? So let's understand this owes and owns and owes. Okay? So everything a business owns, which is the assets, will equal everything the business owes. Now, everything business owes, it can be divided into two parts. If owed to a third party, that's a liability. If owed to the owner, that's the equity. So assets equals liabilities owed to third parties, everything owed to third parties, plus capital, everything owed to the owner of the business. And this is the accounting equation. Now let's try and do an example, and hopefully it will help us understand better. Now, we do a simple exercise here. So example here, Mary decides to start a business with 15 pounds. She has 15 pounds only. So Mary decides to start a business with 15 pounds in her pocket. She wants to buy and sell exercise books. So therefore she goes to a shop and buys 20 pounds worth of exercise books. She pays only 15 pounds, which is what she had at the beginning. So she pays 15 pounds that she had and agrees with the shop owner to pay the balance at a later date. Okay, let's put this, or let's try and illustrate this exercise using the accounting equation. Now to recap, accounting equation, let's do here. Accounting equation is defined by assets equals liabilities plus capital, or owner's equity. Yeah. Now let's do, I will try and illustrate the first paragraph of the exercise, then we proceed further. So up to here, let's try and illustrate at the beginning where Mary only has 15 pounds and she hasn't bought anything yet. Let's put this, or let's illustrate this using the accounting equation. So Mary decides to start a business with 15 pounds in her pocket. She wants to buy and sell exercise books. So up until this point, Mary has not bought anything. She's only got 15 pounds in her pocket, which she has decided to inject into her business as the capital. How are we going to illustrate this using the accounting equation? The 15 pounds that Mary has will be the cash. Cash is an asset. Cash is an asset. So asset here, Mary will have cash, a cash of 15 pounds. Sorry, she'll have a cash of 15 pounds. Okay, and then so that's her cash. That's her. So the 15 pounds is the cash, which is the asset, will equal to liabilities. At this point, Mary does not have any liability. She does not owe anybody any money. So liabilities in this case would be 0. Okay, and then capital. Mary at this point has 15 pounds, which she has decided to inject all of it into her new business. So the capital is 15 pounds. So therefore 15 pounds equals 0 plus 15 makes 15, and therefore both sides are equal. The accounting equation, assets equals liabilities plus capital. Both sides balance out. Okay, now let's proceed further to the second part of the question, which is to the second part of the exercise. Now she goes to a shop and buys 20 pounds worth of exercise books. She pays only 15 pounds that she had and agree with the shop owner to pay the balance at a later date. So how are we going to illustrate this using the accounting equation? So again, let's write down our accounting equation. Just a second. So accounting equation is assets equals liabilities plus capital. Now, assets here, on the second part of the exercise, Mary spent 20 pounds to buy the exercise books. She only had 15 pounds, okay? So meaning, at this point, Mary does not have the 15 pounds cash she had at the beginning. She has 0. So in terms of cash, she has none. but she has something else in form of assets, and that is the exercise books. The exercise books here will be defined as stocks or inventory for her business, and these are assets. So she has stocks here, which are the exercise books, and these stocks are worth £20. Okay, now £20 here will be equal to, she went to the shop, she only had £15 in her pocket, okay, but she bought stocks worth £20, so she owes the shop owner £5, okay. So now she is in debt to a third party who is the shop owner of £5 in money. She owes the shop owner £5. Now if you come here to liability, she has here a creditor. Okay, if you owe your supplier a certain amount of money, that supplier is your creditor, and this creditor is owed by Mary £5. And then you come to the capital. How much did she inject to the business? She injected £15. So now if we do the accounting equation, that will make £20 will equal to £5, which is a liability, and capital here £15, and that would be 20, and both sides balance. Assets equals liabilities plus capital. It's the basis or the foundation of the double entry concept there. Okay, so to recap quickly, the accounting equation: assets equals liabilities plus equity or capital. We know what assets are, we know what liabilities are, and we know what capital are, what capital or equity is, and we know that both sides have to be equal at any point in time, and that is the accounting equation. I hope you've understood. Thank you for watching.